Trump's trade war sent the S&P 500 tumbling nearly 2% at the start of trading on Monday after slapping 25% tariffs on Mexican and most Canadian imports, as well as a 10% tariff on goods from China. The size of these tariffs and the breadth of what they cover is larger than a lot of investors expected, and if we don't see a settlement negotiated soon, there could be a lot more downside from here as the risk of an economic slowdown and reignited inflation get baked in. A number of quality stocks have sold off on this news, so I used our website Simply Safe Dividends to put together a broad portfolio of U.S. companies that pay dividends, which will make it easy for us to review the best and worst performers as the market digests this news. Here's a look at our U.S. dividend stocks portfolio. Just over 900 holdings. This is going to include a really broad cut of America's most popular and highest yielding dividend stocks. I included some columns that I'm hoping will make it easy for us to get a snapshot of each business we go through. So you can look at the sector column here to get a feel for what the business does, company size and the market cap column, the stock's latest dividend yield along with a look at its 5-year historical yield chart, our dividend safety score and valuation metric, the company's latest dividend raise or cut, and the S&P credit rating over here on the far right. So sorting by the price column, the S&P 500, by the way, is down about 1.7% at the time of this recording. So these stocks that are having an up day are really having quite a nice day in this environment. And it's not a big surprise to see the 3 biggest winners are all coming from the precious metals space, gold and silver stocks. AEM, Pan American Silver, Kinross Gold, KGC, they're all up about 2-3% today. Gold moved to a record high, probably reflecting both general fears of uncertainty with what this could mean for the global economy, and also some concerns about inflation moving higher if these tariffs do raise costs across the board. Precious metals usually do well when those expectations tick higher. I also noticed some healthcare stocks. You can see AbbVie here, a big biopharma, up about 2.5% this morning. There are a few more down here on the list. You see Elevance Health, a big Blue Cross Blue Shield insurer, up about 1%. I know that United Health was also up, yes, about 0.5%. You see Gilead up about 0.5%. So why is healthcare doing well? I think unlike areas like industrials, consumer goods, auto, you see the healthcare space being very domestically focused, so more insulated from potential retaliatory tariffs from Canada and Mexico and China. They don't really serve foreign countries. They don't really have supply chain risk either. So I think also being a defensive space with this news creating more uncertainty for investors, healthcare kind of has a lot to offer by just not having exposure to some of the concerns that are in the crosshairs right now. And a lot of these companies have been pretty beaten down. Elevance Health, with their medical costs rising in parts of their business, you can see the stock has really taken a big hit here, looks potentially cheap. So low expectations are probably helping some of these healthcare stocks as well, since that sector did pretty poorly the last couple of years. We also see some staples, Church & Dwight up here. I saw Procter & Gamble, Clorox is also here. These spaces do well, again, when there's kind of fears of the tide going out. If there is a recession, a lot of consumers will keep buying these brands. These are reliable cash cows with pretty strong balance sheets and really great dividend track records in most cases. So some of these companies could face some higher input costs, and consumers might trade down from some of the higher priced branded products, but the market is kind of voting that some of these businesses are pretty well positioned if we do see a slowdown. Now you'll see a few energy stocks on the list as well. We have Baker Hughes. I noticed there were a couple of kind of gas focused businesses as well. We have Imperial Oil, Sunoco, Cortera, Hess Midstream. And oil and gas prices are up because although the tariffs Trump placed on Canada for oil are lower, I think 10%, this could lead to, again, if there's some retaliation, you could see some higher energy costs and disruption in that whole flow of oil and gas. So seeing some moves up in those companies. There's a few utilities in the list, another area of flight to safety, just like Verizon, up 1%. AT&T was on here somewhere as well. Con Edison up 0.5%. So the market is really just bidding up defensive areas as well as some spaces that could benefit a little bit from the tariff situation like we saw with energy, at least in the near term. Another one that's more directly tied to a potential tariff beneficiary, let me see if I can spot it on here, was Weyerhaeuser, WY. If you're not familiar, this is a timber REIT. The U.S. lumber situation, I think Canada accounts for maybe 20 to 30% of the lumber the U.S. consumes each year. Yeah, here's Weyerhaeuser up 2%. They're a timber REIT. So if the cost of their foreign lumber competition is rising, this type of business could be better positioned to kind of keep or even raise prices and enjoy some better near-term margins. But again, those are pretty short-term focused reactions here. So I wouldn't read too much into them unless you really believe this type of event is going to be drawn out and really kind of change the long-term outlook, which I think is unlikely, but we'll see. It's early days. All right, I'll sort by the biggest losers now. And at the top of the list, we see Magna. This is actually a company that I kind of liked last year. I think it's an interesting cyclical stock if you're willing to dabble in those. You can see its stock is extremely volatile. Magna is an auto parts supplier, one of the biggest ones in the world. It's been around for almost 70 years. The parts it supplies everything from seats and mirrors, electronics, lighting, body structures used in both EVs and traditional cars. Very diversified with GM, Ford, Tesla, Toyota. All the big car manufacturers are customers of Magna's. But a lot of these parts do come from Mexico. So even if Magna's supply chain is more domestic oriented, this is a Canadian company, by the way, so that's another concern. But their customers could face production disruptions, and that could cause kind of a potential demand slowdown or even a shock, depending on how tough things get. Magna did maintain its dividend during the pandemic, but it had to temporarily suspend the dividend during the financial crisis when some of its bigger customers went bust. So depending on how drawn out this gets, Magna could face some more pressure. I mean, right now the business is nicely profitable. Free cash flow very comfortably covers the dividend with a 50% payout ratio, but that could change quickly if these tariff situations escalate and become a bigger concern. If a settlement is reached with some of these countries like Mexico and Canada, Magna could be a stock that rebounds pretty quickly, but there are some definite challenges in that space. You have to have kind of a stronger stomach for those stocks. But you'll see a number of auto parts suppliers on this list. You have Lear down 8%. One of the interesting companies is Canadian Pacific. This is a big railroad business, down 8%. So railways are awesome companies. Warren Buffett has owned a lot of these over time in Berkshire's portfolio and still does. But they move a lot of commodities, grain, coal, consumer goods, chemicals, auto products. So if you're worried about trade slowing, especially from Canada to the U.S., a business like this could see its volume slow down and take a decent-sized bite out of profits. But railroads are kind of a monopoly-like business. They're a very efficient mode of transportation. Very hard for me to kind of imagine the long-term outlook structurally changing for railway companies. So the couple that you'll see on here that have sold off, Canadian Pacific. There's another, I think CNI was also off today. Yeah, off 5%. I think those are some of the more interesting companies on the losers list today if you're a long-term investor who's willing to kind of deal with the potential for things to get worse before they get better. We see FedEx is off 7%. Again, this is kind of a business that does a lot with the movement of goods worldwide. So any sort of disruption to those trade flows could kind of hurt FedEx's business in the near term at least. Honda, big auto company, off 6%, not a big surprise. We're also seeing some of the banks, especially Canadian banks like Canadian Imperial, CM, off 6%. And this is reflecting, I think, concerns that Canada could tip into a recession due to this trade war. The reality is the U.S. matters a lot more to Canada because I think about 80% of goods that Canada sells abroad go to America. So these tariffs could really cause some challenges there. And the banks usually underperform in recessions because they experience more credit losses. A lot of their customers just face harder conditions. Loan growth slows, all that stuff. But these companies are amazingly resilient. CM has paid an uninterrupted dividend for over 150 years. These banks are very well capitalized. We have an A+ credit rating here for CM. So a lot would really have to go wrong to kind of rock the boat with the dividend, but you might see even better deals if this does tip Canada into a recession. The financial sector is a space that probably gets hit pretty hard. We're also seeing some disruption here in the chemicals area. Some of these are tied to fertilizers like Mosaic. Again, not a huge surprise. A lot of these are exported worldwide, and some of these commodity chemicals are also very tied to global economic health. So if there is a big slowdown in a lot of these countries, you're going to face potentially both higher costs and less demand. So not a big surprise to see some of these cyclical chemicals companies on the decline. We also have a couple RV companies, Thor and Camping World, both off 5%. Again, I think that's reflecting concerns about their supply chains, being able to get the parts they need to make all these things. So we'll see how well these companies have kind of prepared since the pandemic world with diversifying their supply chains. But with Canada and Mexico both facing these tariffs, that's going to cause some challenges if this does extend into a long, drawn-out battle. Another auto parts here with Borg Warner off 5%. BNS, Canadian Bank, off 5%. Stanley Black & Decker, Dividend Aristocrat, sells a lot of hand tools that you're going to find in stores like Lowe's, Home Depot, DeWalt, Craftsman brands. This business has been challenged by high interest rates. It's kind of caused dividend growth to slow to a crawl, 1% type raises. And they've really been hit hard since the Fed started cranking up rates in 2022. That slowed the housing market, reduced demand for a lot of their tools. They had to work through too much inventory, a lot of significant commodity and transportation inflation. So now dealing with potentially higher component costs with some of their production footprint abroad and in Mexico could make the near-term outlook additionally challenging for Stanley Black & Decker. Here's CNI, another Canadian railway company. I think, again, this is the type of business that would kind of catch my eye. It's trading at a 52-week low. Hard to imagine the long-term outlook for rail has really changed a whole lot. Stock is starting to look undervalued if it would trade back to where its yield usually sits. So those are the couple that would stand out to me most as a long-term investor, the railways. Otherwise, a lot of stuff in here is kind of just cyclical, harder to kind of buy into the long-term case for being a bigger, more profitable company. But if this environment gets really bad, you could find some interesting cyclical stocks in here to kind of hold your nose and buy. But this is just kind of the day one reaction we're seeing. So we'll keep an eye on all this, and it's a very dynamic situation. I think if a settlement gets reached quickly, you could see a lot of these cyclicals snap right back, and hopes that the expanding economy is on track. All of that would hopefully alleviate some of today's pressure. But we'll see. A lot can change quickly. It's been a couple of very exciting weeks since Trump took office. As a conservative long-term investor, I really don't place much, if any, weight on short-term macro events like this. I don't think anyone can successfully time the market or predict sector rotations any given year, so I don't try to either. With my own portfolio, I'm focused on owning a diversified basket of high-quality companies that generate predictable cash flow, maintain strong balance sheets, pay safe and rising dividends, and seem likely to be larger and more profitable a decade from now. Could global trade get reshaped and impact some companies' long-term outlooks? I guess it's possible, but it seems pretty unlikely to me, especially in this early stage of negotiations, so I'm ignoring most of this noise for now. I hope this video gives you some helpful perspective as you get bombarded with headlines about trade wars and tariffs. If you enjoyed it, it would really help me if you hit the like button for the video and considered subscribing to our channel, where I share dividend stock analysis and investing tips with a few videos each month. No nonsense, just objective, fact-based, rational takes. If you have your own dividend portfolio, you might also want to check out our website, Simply Safe Dividends, which makes it easy to keep your portfolio between the guardrails with our dividend tools and research, including a portfolio tracker, dividend safety scores, a stock screener, a quarterly newsletter, company analysis pages, valuation charts, and a whole lot more. The site is free to try and only takes a minute to get signed up using the link I'll drop in the description below. Thanks for watching, and I hope to catch you next time.